Bank of Canada just removed stress tests for refis and financing from CMHC up to fourplexes. Well, we uncover all this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, once again with our favorite mortgage broker in all of the land. We take 1 week off, Dion, and the news hits the you-know-what.
Yeah, there's so much to talk about, and again, we missed our regular scheduled time because my kids got sick. So then I got sick and I lost my voice. So I'll do my best to vocalize everything that's been happening the last little while.
Vocalize. There are people singing and yelling from the mountaintops, and there's a lot of I don't want to say misinformation up there, but maybe misinterpreted information. There's lots that the government released over the last, say 14 days. And of course, now, time is always of the essence where you have time to reflect and research and figure out what's really going on. So lots of changes from the Canadian government and CMHC and everyone in between. Where do you want to start with what's the latest?
So actually, let's start with OSFI, which is the regulator for mortgages in Canada. And in particular, we're going to be talking about the stress test. Okay, so Gary, you and I for months and months have been talking about the fact that when you come up for renewal on your mortgage, that if you have an insured mortgage, that is, you borrowed more than 80% of the loan when you first got your mortgage and you wanted to move that mortgage from lender one to lender two, you could do so without being exposed to the stress test, which basically tests your ability at the contract rate plus 2%. So it basically makes it about 30% more difficult to qualify, right? So first, high ratio borrowers were not exposed to the stress test at time of renewal or switching to a different lender. And you and I were screaming about the fact that why is it only available for high ratio mortgages? The majority of mortgage holders in Canada are what we call conventional mortgage holders, meaning that they have, more than 20% equity, or that when they secured their property or purchased it, they put more than 20% down. Those people were also exposed to this stress test at the time of renewal, which makes it very difficult for you to go shopping for a better interest rate, because you might have qualified for that mortgage back in the day when the stress test didn't exist. So many people felt stuck, and it caused, in my opinion, a very anti-competitive environment, right? It just made it harder for Canadians to move positions. Now, the good news is this has finally changed. So conventional mortgages on a time of switching have now the same rules as insured mortgages at the time of switching. No stress test. It's going to make it about 30% easier for Canadians to move from lender one to lender two. And the question is, why wasn't this done sooner, right? Why was this not done sooner? The rumor is that when the stress test was introduced, that the banks lobbied the government to say that if the stress test is going to be introduced on acquisition of the mortgage, they wanted it in place at the time of renewal, which would then allow them to contain their client and capture their client and not have them move. Now, is that true? I don't know, but this is what's been floating around as, what was going on behind closed doors in Ottawa. But anyways, we are where we are. Things are better.
Yeah, things are better. And this is, who does this benefit? This really benefits us, the borrower, the consumer, because now there's a little added competition to your mortgage rates and the products that are out there, and your current lender is going to fight much harder to keep you, and the opposite of that, other lenders are going to fight much harder to attract you, right?
Yeah, exactly. And I think this is going to fuel a lot of a bit of a frenzy in the next couple of years, because as you and I both know, 2020, 2021 were the highest volume purchase years across most real estate boards. And all of those mortgages are coming for renewal, assuming they were 5 years, and the majority were, they're coming for renewal in the next 1 and 2 years. So this introduction of this relaxation is really coming at the right time.
Yeah, that's good. That's good. Okay, moving on. The news was, hey, CMHC is going to provide financing or assisted financing, insured financing is the word I'm looking for Fourplexes. This is exciting. However, let's peel that onion.
Yes, so this is hot off the press as of this morning, or yesterday evening rather, where, and this has surprised me and pretty much everybody in our industry. Guys, firstly, when refinancing, when going to your bank to try and borrow more money, uh, every bank in Canada is capped at lending you 80%. So, put for simplicity, if you got $1 million property, the max you could refinance to is $800,000. Okay, 80%. This morning or yesterday, the government has announced a plan to introduce refinancing up to 90%, which takes you into mortgage insurance territory under some very specific guidelines. Okay. This 90% refinance is only if you own a property and you have the intention to take the existing property and convert it into 4 units. Okay. So, what the government is doing is trying to create housing by incentivizing Canadian homeowners through making financing easier to go and build not just the unit that them and their family live in, but 3 more units in their basement or on their property, garden suites, ADUs, or whatever that case may be. So this kind of, again, way out of left field, wasn't on anybody's radar, nobody's radar that this was going to happen. So let me just sort of run through some quick numbers here to make sure I haven't missed anything. So they have to be on, obviously, legally built 4 unit buildings. Hang on. Now, hang on. Again, this is new to me too. So I'm not sure if it is you have to build 4 or you can build up to 4, but it's for the addition of units. Okay, I think it might be for up to 4 units. So maybe if you're building a triplex, you might still qualify. And again, this is fresh off the press, so forgive me. The starting date of this, whereas those other CMHC rules start December 15, these start February 15. Sorry, January 15. January 15. So that's the big news on our side.
So I have a couple of, just to dissect that a little bit. This is for existing properties only. So you can't go obtain a new building and get this type of financing for it. However, and I'm throwing you a curveball here. What if we go buy a single family home that has capabilities, of that fourplex type situation? We go put short term financing on it, meaning 1 year open or something like that, and then now we own it. Do you think we can obtain that new CMHC financing once I own it?
You're talking like a real estate investor person there, Gary.
I
But
shouldn't do that.
100%, my interpretation is in line with yours in that if you go buy a single family home, let's say you've looked around at the area and there's precedent for the ability to add more units and you have enough land to do so, then it would be reasonable to think that after acquisition, you go and get the plans and the permits and all those things, then you would have what you need to then refinance after the fact and then go and build those extra 3 units on that property. So I can imagine that there will be some people who will pursue this. I did some quick math here, and by the way, this is available for properties up to the value of $2 million, meaning that 80% of that number, 90% of that number is $1.8 million. And just interestingly, you need a household income of at least 350 grand to qualify for that number. So just keep that in mind. Even though this is possible, you still have to be able to qualify.
Yeah. Yeah. And this is really okay. Why are they doing this? This is obviously to increase the number of available rental units throughout Canada, in a sense, but in the more populous areas like Toronto, Vancouver, and elsewhere where there is a lack of rental units, or those rental rates are moving on up. I did see a note, a stat this morning to say across the board in Canada. So I want to make sure people understand this right. Across the board, rental rates have come down ever so slightly. However, when you start peeling that onion away and looking at some of those more populous areas, like we just said, that's really not the case. You're still, you're still doing your best to put your best foot forward to get a rental unit. Okay,
Yeah,
so
most definitely. Actually, Gary, I'll just expand on something there, which is, again, we've done some programs where we've discussed this very ambitious goal of 3.8 million homes by 2030, right? And what we've all seen this year is your traditional developers say the math doesn't math. I'm not building more property, right? And I'm sure what the Canadian government has done is said, we promised the Canadian public that we would be on track to build 500,000 plus homes every year for the next 6, 7 years. That's what they said. And as we're approaching the end of this year, they're seeing that they're nowhere near that number. And so, why are they introducing this new financing? It's so that your mom and dad homeowner can become a mini developer so that they can help the government hit this very audacious target of 3.8 plus million homes by 2030. So yeah, that's how I read this.
yeah, yeah. Okay,
Mhm.
that's a great segue into our next little topic here of the amortization. I shouldn't say we all got excited, but there are those that got excited that we can now obtain that 30-year AM. And again, as we've had some more time to dwell on it and read all the information about it, let's dissect that a little bit of what that actually truly means to the borrower.
Yeah, you bet. So the first thing I want to say is that there's this misconception that these new mortgage rules, which are the 30-year AMs and the $1.5 million cap, many people think that's only applicable to first-time home buyers. But the reality is, almost all of these new changes are applicable to second, third, fourth-time home buyers. So you do not need to be a first-time home buyer to take advantage of these new rule changes, with one exception. And I think it's probably easiest, Gary, if you pull up that quick spreadsheet that I threw you before, and I'll explain it sort of line by line here. So, guys, uh, first line here is talking about the purchase limit, and we've got column one, column two, first time buyer and non first time buyer. So this $1.5 million purchase limit applies to both first time buyers and non first time buyers. The down payment is also the same for first time buyers and non first time buyers. Okay. And if you're a first time buyer or a non first time buyer buying a brand new construction, okay, then you do get access to the 30-year amortization. Okay. And the next line there is if you're a first time buyer buying a resale home, a home that's been previously lived in, again, you get access to the 30-year amortization. So here's where the difference is. If you're a non first time buyer and you're buying your second, third, fourth home, and this home is a resale home, not a new build, then you will only have access to 25 years amortization. So that's the only difference. Okay. And interestingly, Gary, in the last 3 weeks, I've spoken to 3 couples who fall into this non first time buyer category who have been waiting for an opportunity to upsize, but they just knew that by selling their home, they wouldn't have 20% down, and they'd be buying over $1 million. So when this introduction of this rule came out, I'm like, I wonder how much demand there is for this type of thing. And I have been surprised that already we've come across 3 couples who have properties that they want to sell for 900 grand or less, and when they sell, they want to buy for 1.1 to 1.3 million, right? So there is demand for this type of transition. Let's be clear though, if you're taking on mortgage insurance, you're putting less than 20% down on a $1.3 million property, you've got some pretty good household income. And in terms of all the people that I've been speaking with, everybody's household income has been in excess of 250 to 300 grand, right? In order for them to be able to qualify. And the interesting thing is, once these guys move up, then their properties become available for those real first time home buyers who need that entry level property. So I'm already seeing that, as much as you and I were a little bit cautious about this, and how many people out there can go and take advantage of insured mortgages up to 1.5 million, I've already come across 3 in the last couple of weeks.
It Well, that's interesting because we wondered how impactful this change was going to be. And as you said, you're starting to see that first ripple effect. But it really is, my friends, it really is a ripple effect of, you know, that buyer moving up or moving out of that house so that, as you mentioned, that real first time home buyer can move in or purchase. Uh, there, there are good things happening. However, we need a few more, and I don't know what those are from the government. Obviously, the most, the one that people will kind of peg their finger on always is lower interest rates and making it more affordable. But that obviously has the opposite side, is that we all know as rates come down, prices go up, right? So there needs to be some sort of mechanism to just slow that down somewhat. Don't you agree?
Yeah, I don't know what that is because, as we've said before, like nobody wants property values to drop. A lot of retirees are depending on that to happen, and it does seem to be just sort of throwing more fuel on the fire. But you know what? If we can help those couples who make 300 grand get out of their 800 grand property and into a $1.2 million property, then the 800 grand property becomes available for that entry level person. And I know it's crazy that we're talking entry level at 800, but hey, man, I didn't make the market. It's just the market it is. Right?
Yeah, yeah, it's the one that we get to work with and
Yeah.
interpret and guide our clients along with. And just a little quick little snippet on what's going on in the local market there. And we'll talk the 416 area code, or Toronto, that is. And just over the last month of September, we have seen the number of sales increase. However, all those stats will be coming out this week because Toronto Real Estate Board and everyone else has updated their stats for September. Just remember that we always see an uptick in the month of September because August is always a slow month. It's one of our slowest months. So we'll always see a little uptick. However, these are good things because we're seeing the months of inventory just drop ever so slightly. There's still lots and lots of units available, lots of opportunity, lots of the homes to go look at. However, just know in the back of your mind, we'll always see an uptick. October will probably be about the same, and it'll be really interesting. I think, is it, we have another week and a half before the next interest rate announcement?
Yeah. 23rd of the month. So a couple of weeks. Yep.
Yeah, it'll be, okay, should we call it? People are asking for that point 0.5 instead of the 0.25. What are we going? What are we going to see here?
So,
What do you think?
okay. So the odds of it being zero are zero, pretty much zero, right?
Yes.
So we're going to get a drop, thankfully. And yeah, will it be 0.25? Will it be a full, 0.5%? If you'd asked me 5 days ago, the answer was, yeah, we're probably going to go 0.5%, right? But as of just a couple of days ago, the US job numbers came out, which were stronger than expected, which means that in the US, the question is, okay, are they going to drop as aggressively as previously predicted, right? Which then in turn plays on the psyche of the people at the Bank of Canada. So the chances of a 0.5% drop are slimmer this week than they were last week. That's what I will say.
Okay, there you have it, my friends. And there's interesting things happening down in the US outside of the election. Of course, we have like the natural disasters and everything, and that all plays into what their economy does. So we'll have to watch that closely over the next few weeks there. Okay, my friends, remind us how to get a hold of you.
Yeah, kangamortgage.ca or on Instagram at the Dion Beg.
There you go. That's Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.